Celsius is down around 12% so far today. In fact, when it opened, it was down around 15%. This is a strong growth company that has performed very well over the last few years. We're going to take an in-depth look. Is it a strong buying opportunity after today's look? We can already see a double buy rating seeking Alpha and Wall Street with a hold from Quant. As always, we are going to do our deep dive while also looking at both insiders to see if they've been buying or selling. Look towards the institutions. We also want to point out some very important details from their latest investor presentation just this month. And as always, we'll look at their underlying metrics, their free cash flow growth, sales, their ROICs, their debt levels, and ultimately see how strong these numbers are, their top line as well as their bottom line net income. We'll also look at the health of this company, their total cash versus their total debt. And ultimately, what we want to find out is what is it in the valuation model? What is our own intrinsic value? What is our acceptable buy price given our investor margin of safety? And what sort of upside does Wall Street anticipate for this growth stock over the next year? So let's jump straight into the historical performance. Now we do know this is a company that is up around 90% just over the last 12 months. And if you've been a long-term holder, well, this could potentially be one of the best stocks that you have bought in your portfolio, up around 43,000%, absolutely astronomical. Now we do note even after the drop today, it is still around the upper end of the 52-week range. And we can see it does trade at a very premium forward PE of over 87. Now a lot of people will justify this based on their incredible growth. So let's take a deep dive at this company and understand whether or not now is a perfect time for some strong growth opportunity into 2025 and beyond. So very quickly then, we want to look at their top line revenue growth, and we will expect a very sharp increase just due to the fact that PE alone. What we notice, 14.6 million reported on their top line in 2014. We're talking about 1.3 billion in that latest annual report. So we can see their top line growth as well as graphically has been astronomical over the last few years. And if this continues, then this could definitely be one that does keep up with that very strong historical performance. In terms of their bottom line net income, well, how does that compare? Well, in fact, we can see very inconsistent, quite a considerable number of years where they were making a net loss. In fact, their first strong year was the more recent year, 2023, 227 million reported. And as we can see graphically, very inconsistent. Pretty much the first year with some solid growth to that net income, something that we will need to discuss when we do consider our margin of safety. Now, in terms of the balance sheet, how does that compare? Well, they had 300, as we can see here, 1,000 on their balance sheet in 2014. They are currently sitting from that latest quarterly report around 880 million. So it is quite a fair amount. We do note it did essentially rocket over the last 2 years. But as always, in isolation, this number doesn't really mean anything when we do compare it to their total debt, both numerically and directionally. In fact, what a sign this is. They had 10.8 million of total debt in 2014. Not only has it decreased over the longer term, but it is very small in comparison to their cash at 2 million. So a phenomenal balance sheet we can already see. And this is something we love to see on this channel. Total debt, in fact, over the longer term, decreasing, a very positive sign. Already we can say this has a very good balance sheet, and the income statement, if they do continue to turn an increasing net income year on year, this is definitely one to consider. Now, in terms of their earnings, how have they performed historically? Well, over the last 4 quarters, we note they did beat 3 of them, so a 75% track record. But what we note is the misses and the beats are very marginal, so we can gain some accuracy in terms of their performance as well as their forecasting accuracy. Over the next quarter, they're anticipating double-digit increases to the earnings per share, and we can see across the next 4, we are looking at some very strong growth. Now, in December 2025, if they are able to achieve their EPS estimate of 151, then it is trading around that forward P of 63, so it is looking like it is lowering, but again, they are factoring some very strong growth, nearly 50% to that earnings per share just into the next year. So let's break that down into different elements. First one that we are looking at today is essentially the valuation grade. No surprises here, they do get an F grade. When we look at it on a PE gap forward basis, we do see 87.08, and we do in fact note here sector median around 19.15. Now, yes, it's ridiculous to compare a company that is fast growing like Celsius to others in the sector median, but it is just one thing that we do want to point out for those that want to see what others are trading for around the 19 level. Again, on every single other other metric, we can see Celsius is trading very richly on a price to cash flow forward basis, 80 versus 12.45. But the whole point of today's episode is to understand whether or not this is justified and whether or not this is one we do believe, for the growth that it does have historically and forward looking, one we should consider. So an F on the valuation grade. When we move on to the growth grade, expected this given the essential forward P, an A on the growth. Revenue year on year, so yes, they do trade much higher than others in the industry, but look at that, 81% year on year growth, others in the sector just over 2%. On a forward looking basis, 52%, as we can see the sector just under 4%, and on the other metrics as well, looking very solid, as we can see here, an A pretty much across the board. So when we then move on to the profitability, an A minus, and as we can see here, gross profit margin on a trailing 12-month basis, much better than the sector, 50 versus 35. Bottom line margin as well, very healthy and strong, 19 versus 5 that we can see here. So very, very positive. Cash from operations, slightly lower, 290 million versus 837. But in terms of summary of this part of our analysis, a double buy rating with one hold, valuation understandably an F, growth and profitability in the A range. So let's keep moving on and understand whether or not this is one that we will be looking to add. Now, in terms of others in the industry, we're just having a very quick look. We can see others, Coca-Cola, they're different areas. We also have Monster Beverage, National Beverage Corp. Now, over the last year, we do notice that Celsius, even after today's drop in the double digits, it is around 91%, pretty much the best performing. Over the last 5 years, again, pretty much the best one without any of them coming anywhere near. And we can see again a very similar story over the last 10 years. Now look, it doesn't mean they're going to continue this over the next 10, but it is just one that we can see historically has performed very, very strongly. So let's have a quick look at the insider ownership. Now 2.2%, as we can see, 14 instances of insider selling, 331 million to be exact. And look at what we see here, just in the more recent quarter, 108 million worth of shares being sold. We see the same in quarter one, pretty much every single quarter over the last 6. Now this, I do believe, is one of the reasons why we do see that massive share price drop in today, the double digits, nearly 15%. Insiders seem to be continually selling. Now this data doesn't get refreshed automatically. So in terms of the more recent one, the 17th of May, we do have a major shareholder selling 40,000, around $93 we can see here for just under 4 million. In fact, the 14th of May, so not too far off, another director selling, and we can see for quite a substantial amount. Now, whether or not you believe this is a bullish signal or bearish signal, whether they're buys or sells, just something we do want to show you that insiders do continue to sell this, and we do believe this to be one of the main reasons for that massive drop today. There is another reason which we will also consider, and we'll discuss that shortly as well. Now, in terms of institutional ownership, 61%, we notice 553 million worth of sales by the institutions over the last 12 months, with a lot more buying during the same period. In fact, just over the last 2 quarters, we see a lot of buying by these institutions. We also see selling, but overall, a lot more buying, not just in Q1, the more recent quarter, but also over the last 12 months. But as always, do your own due diligence and never just copy whatever these insiders or institutions do. Now, before we move on to the investor presentation, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on that pinned comment below. For example, if you want to see 20 undervalued stocks that we do believe you should consider in the portfolio, or any websites that we use, our resources, we do explain it all here. Do click on the pinned comment, instant free access as well. So they did just release their latest investor presentation from their earnings May the 7th, so a few weeks ago. Few things that we do want to point out. First one is that they are a growing brand, as we can see just over the last 5 years. In terms of their sales in the retail channel, it has grown pretty dramatically, and we can also see in terms of the percentage contribution to the energy category, it does continue to increase year on year, which is always great, something you do want to see, and maybe something you do expect, given the company does have a very high forward PE. The next thing to note is their global expansion. We can see from essentially 2024, they are looking to essentially expand into Australia. We can also see that here as well, that France is another area, but again, something that we will consider very shortly, the other areas that they're looking to continue. It isn't just 1 or 2 countries. In terms of their actual performance, quarter on quarter, top line as a whole, 37% increase, North America 37%, international 43%, and what do we always say on this channel, where you want to be looking at strong companies, not only increasing their top line revenue, but also their gross margins, which we can see they have done considerably as well. Nice to note they have in fact dramatically increase their net income, and the same can be said for their earnings per share. Again, they're anticipating this trend to continue around 50% into the next few years. So lots of positives to note. They are continuing to increase. Again, this is what we would expect, but nice to have this reaffirmed. In terms of the shares in the energy industry, we do see currently third place. They are a little bit away from Monster and Red Bull, but again, if this does continue the very strong trend they're having, it may not be too long before they are very close to overtaking Monster. But as always, do let me know your thoughts below. This isn't an energy drink that I have personally tasted, but again, let me know if you have, whether or not it does come close to the likes of Monster and Red Bull. Finally, the last thing that we did want to point out from this investor presentation is not only their international sales are increasing, but we can see here the UK sales did begin just a few months ago in 2024. We can see the same with Ireland, Australia, New Zealand, and France as well. So lots of positives to take over, in my opinion. But again, as always, one thing that is very important is essentially getting that valuation piece correctly. In terms of free cash flow per share, now what we always want to look at is increasing free cash flows over the longer term. Nice to note the last 2 years have been positive, as well as 2024 anticipated to be an increase around 74 cents. So that is always a great sign. Sales growth, wow, I mean the last 3 years, triple digit growth, very strong. Usually we look at this up to around 2020 or 2021 and see that it is starting to slow down in 2022, 2023. Nonetheless, 2024, in fact, trailing 12 month at 81% still shows that there is a lot of growth left for this energy company. Total sales, numerically, we have seen this before, so just another format. And again, yes, we love it when companies do share buybacks, but what we note is they have diluted your position over the longer term. Now, this is probably something you don't care about at all if you have been an investor since 2014, given the share price increase over the period. But again, just something to factor if you are a relatively new investor to this company or a potential investor at the minimum. ROIC, very important, but again, as we know, whilst we want 10% or more to give us faith that management are able to effectively allocate their capital, we do in fact note that this is negative, as they have been turning a loss for the majority of the last 10 years. 2023, a very strong increase, 24%, looking very healthy. Trailing 12 months at 26% also gives us faith that they will be able to continue these high numbers. Operating margin, first year positive, or second in fact from 2020. 20%, very nice. We do want a minimum of 16%. Trailing 12 month at 22, looking very good. And the free cash flow margin, last 2 years, looking good at a minimum 5%. Trailing 12 month, looking even better. So looks like the growth, the best part, is still to come. And no surprises on the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Remember, correlating to balance sheet strength, effectively indicating, with these numbers being the number of years it would take the company to pay off all of that debt net of cash on hand, that it won't even take them a phenomenal balance sheet, and in 2024 expected to be the same. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now the first model, and the only model that we do believe attributable to Celsius, ticker symbol CELH, is the DCF model. Now we have the free cash flow year on year. We can see it is increasing at a very strong rate just in the last year at 24%, 200% in 2020, and we do believe now they have started to turn a profit. These numbers will continue to increase. So we have gone for 3 levels, so you can see low, medium or high. We have essentially the first low level at 25% with free cash flow growth year on year. With essentially the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we can see an intrinsic value of $53. Now market price around 83, we do get an overvaluation signal, and this effectively implies around downside of negative 36%. Now, if you believe that the growth will continue at an even faster rate, at 30% we can see an intrinsic value of around $72, and therefore this is implied downside of 13%. But if you're someone that believes no, this will go even higher, a lot of growth is still to come, 35% would be an intrinsic value of $97 and implied upside around 17%. Now just bear in mind, you can grab a copy of this model, which does cover the other 3 models as well if you want to run your own companies through. If you want to get your own intrinsic value as well as your own acceptable buy price, play with these numbers, etc. by clicking on the pinned comment below. Now today's episode, we will go with the medium rate of 30% just so you can see it through to the next slide. So this gives us an intrinsic value here in today's episode based on this around $72. Now what we typically do is we would run our margin of safety at 10%, and we would say we only execute on these companies at 10% if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now if you believe that, it would be by around $64.59. Remember, this is based on a growth rate of 30%, and we can see here this is a 10% MOS, but right now it doesn't even warrant a 0% margin, so you are currently paying a premium in our opinion, and again that is for a very high forward expected free cash flow growth rate. In terms of Wall Street and their expected price, while they do still see upside of $92, 13% over the next 12 months, but the issue that we have with this company, other than the fact that one, it doesn't have a nice margin of safety where we typically may look for around 10 to 15%, which would be around $65 to around $61, is the fact that one, as we saw, a lot of insider selling continuously year on year, quarter on quarter, putting a lot of downside pressure onto the share price, as well as there are some issues now that are coming about with the ingredients that they do use within their drinks, which is causing some stir as well, which may not be too good unless they do come out and explain that. So lots to consider with this company. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and as always, we'll see you all on the next one.